The market has just opened today and we see red right across the board, other than maybe Nvidia, which is up around 5% already. Now our focus is going to be on Pfizer. Now this is a company that is down 20% over the last year, but currently does offer a nice yield around 6%, which we do believe will be more attractive as interest rates do get cut over the next few months. Now, is it undervalued? Should we buy it right now? We're going to dissect that information in today's episode. First things first though, let's look at some underlying metrics. What we note here is dividend safety score sits at 75 safe, and they did increase the dividend, although we can in fact see December 2023 at 2.4%. Not great, and in fact lower than the inflationary rate that we do target on this channel. Now we can see that the score was reaffirmed in May of this year, and what it ultimately means is that a dividend cut is unlikely. As always on this channel, we like to look at the key metrics from the last recession, in fact the Great Recession 07-09. We can see for Pfizer, they in fact cut the dividend. They had above average growth. Now that's a negative 6%. Remember the S&P was around negative 12. And they also marginally outperformed, negative 45, with the S&P itself negative 55. Now, yes, we didn't like their increase last December. However, over the last 5 years, they have managed to keep it up in line with inflation, which isn't too bad if you are looking in a yield around 6%. And over the last 20 years at 5%, marginally higher than inflation. Now, we also do want to point out they have been increasing those dividends for the last 13 years. One of the things we like to look on this channel is dividend yield theory, which tells us a company is undervalued when the current yield sits above the 5-year average. So we have our first massive undervaluation signal, another signal 10.9 on the forward PE, 5-year average sitting at 12. In fact, in today's episode for Pfizer, we are seeing a triple undervaluation signal as the healthcare sector does sit much higher at 16.5. The next thing we want to draw your attention to is the free cash flow payout. Below 60% is what we want to see. Now, why do we use this? Ultimately, it does let us know that management can offer those double-digit increases we love to see. Bit of a red flag indicator in 2023, and this is one of the reasons why we focus on free cash flow. Earnings is susceptible to manipulation by management through accounting and doesn't tell us when we are going to see any potential dividend cuts. 2023, 193%, tells us that management paid out more in dividends than they generated in free cash flow. The nicer thing to note here is that over the next 12 months, it is anticipated to come down to around 71%. As always, free cash flow per share, we do want to see consistent increases over the longer term. We actually see a decrease from 2014 to 2023, but no surprise if you have been following this company. In fact, 2021, 2022, the COVID era, we did see some very large boosts, not just to the free cash flow, but also to other metrics, as we will come to learn. And in 2024, it is anticipated to increase significantly to 235. In terms of sales growth then, as we mentioned, the COVID era, very strong for their top line revenue. And prior to that, not looking the greatest, in all honesty. 2023 as well, negative 42%, which means when we look at their numbers numerically, it has gone from around 50 billion in 2014 down to the lows of 41 billion in 2018, highs in 2022 at 100 billion, and it has come shattering down to 58.5 in 2023. So bit of a roller coaster if you are a shareholder, as we can see here, but if you do understand some of the factors behind the numbers, then you could argue it is fairly justified. Then we get to the shares outstanding. As always, we want to see companies that do share buybacks, returning excess cash. What it means is you have a larger portion of the company through those share buybacks that management do, and they have bought back nearly 1 billion of shares, 6.42 down to 5.65 in the latest quarter. We then move on to ROIC, very important metric on this channel, return on invested capital. I personally want to see 10% or more. Give us faith that management are able to effectively allocate their capital. Very inconsistent, and we do know for pretty much a significant number of years it has been above that level. 2023 though, it has come down. Trailing 12 month at 2% doesn't give us too much confidence as well. Something to bear in mind, maybe factor it into the margin of safety that we will come on to. We then have the operating margin. We want to see 12% or more at a bare minimum. They've hit that every single year. Unfortunately, 2023, we do see it slip significantly below from the highs of 39%. Trailing 12 month, not a great sign as well. Operating margin, the lower it gets, the more chance it is that they will in fact have a loss at the bottom line instead of a profit. And free cash flow margin, you could have argued from 2014 to 2022, this was a free cash flow machine. And whilst it is still above the minimum we want to see at that 8% point, we want to see it back up to the high 20s or the high 30s we have known historically for Pfizer. The last metric we're looking at is the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. Below 3 is what we want to see. Numbers that you see below, in fact, tell us the number of years it would take the company to pay off all of their debt net of cash on hand. And why we love this metric, it correlates to both dividend safety and balance sheet strength. Now, 3.75 is in fact the first out of the last 10 years where it has gone above that level we want to see. Positive to take from here. Over the next 12 months, it is anticipated to come down to around 2.7. Now, we also want to let you know we have released our latest free weekly article where we talk about 3 undervalued dividend kings, as well as running through what the Japanese carry trade from last week actually means in very simple terms. If you want access to this or any other articles, all completely free, you can click on the pinned comment below, sign up and read straight away. And in fact, we've also released our 35 undervalued stocks for the month of August and talk about all of those as well that we hold in our own portfolio. Continue on with the analysis of Pfizer, we also look at insider and institutional movement, starting off with insider ownership at 0.06%. No insider selling over the last year. We do notice one instance of insider buying, $79,000, fairly trivial, so probably not something you want to include in your own investment thesis. And we can in fact see you'd have to go to Q4 of 2023 to see any movement, which is that insider buy that we talked about. For transparency, if you do want to see who in fact that was, it was the director on the 15th of December, bought around 3,000 shares, and there it is, that $79,000 total. Now, we also noted here US Congress members buying and selling shares, not something that we particularly add into our investment thesis, but the information is there if you want to take a look. Then we take a look at institutional ownership, which is 68%, 9.1 billion worth of sales over the last 12 months. We pretty much see on the first time on this channel the same amount of buys that we see of sales from the institutions over the last year. We will, however, point out that in the more recent quarter, we do see marginally more buys than sells by the institution. Remember though, institution, insiders, buys or sells, always do your own due diligence and never copy any of their trade. Moving on then, we also want to point out, whilst they have had a horrific performance over the last year, down 20%, over the last 10 years, it hasn't looked much better. You would be up 5%. Bear in mind though, this is if you had bought 10 years ago. For example, if you had bought in that COVID drop, it was trading at around $27, which interestingly, you would have had a very small gain from that point 4 years ago. So something just to consider. And we do notice all-time highs December 2021 at around $59. So right now it's trading in the mid to lower end of the 52-week range, a double buy rating with a hold from quant. As we mentioned already, maybe a fairly attractive yield, especially if you anticipate cuts to come quick and fast over the next few months. And we can see here forward P sitting just below 11. Now, continuing on with the income statement, whilst we have already run through their top line, we did mention the inconsistency, and we can see it here again clearly and graphically from 49.6 billion to around 58, although we did point out the COVID highs. What our main point here is to analyze their bottom line net income, see the trend from here, and in fact, again, very similar to their top line, 9 billion in 2014. The latest annual report, they in fact had a much smaller net income of 2.1 billion. And when we look at their bottom line graphically, again, inconsistency is the word that comes to mind. Then we want to look at the health of the company, very important for a company that pays a nice yield, total cash versus total debt. We want to start off with the cash and short-term investments, 36.2 billion in 2014, 7.1 billion in their latest quarterly report. So actually it has been decreasing. Now this isn't necessarily a bad sign. They may have used the cash, which actually in this case, they were looking at doing some acquisitions. If you've watched our previous episodes, we actually talk about those specific ones, CGen being one of them. And when we take a look at the 7.1 billion, in isolation, as always, that number won't tell us much, which is why we compare it to their total debt numerically and directionally, which has also increased rapidly from 37 billion, which you could already argue was a large number, to around 70 billion in their latest quarterly report. So something to consider as we did look at the net debt to EBITDA. the dividend does look to be safe for now, but definitely one to consider in your investment thesis and maybe add a slightly larger margin of safety if this does concern you. We also like to look at their earnings, how have they performed against analyst targets, what are the future expectations. Well, for Pfizer, they actually outperformed what management and analysts had targeted 4 times out of the last 4 quarters, so 100% track record. And we can in fact see for December 2025, if they hit their estimate, the forward PE will come down even further to just below 10. Now, for those that are interested in what happened in that earnings, well, it was released, in fact, just a few weeks ago, and we can see they actually hiked their full-year outlook, and they also talked about how they are looking to cut costs. So, pretty good in my opinion. You have a company that, in fact, beat on both the EPS as well as the revenue. They also raised their full-year outlook, and they're also looking to cut costs. How well did they perform? Well, just for those that are interested in seeing the numbers, 60 cents versus the 46 expected. Pretty strong beat in my opinion. And the revenue as well, 13.3 versus around 13 that the market is expected. And we can in fact see a lot of cost cutting that they are anticipating. Around 4 billion was what they were anticipating by the end of 2024. And on top of that, they were looking at doing around 1.5 billion by the end of 2027, which will ultimately help boost that bottom line for shareholders. Next thing we want to look at are some gradings and underlying metrics. The first one is valuation, where Pfizer get an A. Now, when we look at it on a non-GAAP basis, forward-looking PE, just under 11, when in fact the sector median is 21. So right now, if you are adding Pfizer shares, you are actually getting a 48% discount to the sector median. Now, do remember, some companies actually warrant to be trading at a discount. Others, though, could be a very strong value play. And ultimately, when you do look at the majority of the different valuation metrics, that Pfizer as a whole is trading at a nice discount to the sector. Next one is the growth, where they get that F rating. Now, year on year, as we already ran through, their top line down 30%. Sector median 6.54%, but that is growth. Forward looking as well, still anticipating a drop around negative 14% to the top line. Sector median better than year on year at 8.7%. And one of the things we draw your attention to always on this channel, EPS over the next 3 to 5 years expected 9%, when we can see here the sector at around 11.6%. So as we mentioned already, there are reasons why companies do trade at a discount, and you could argue that it might be justified for Pfizer. Then we get to the profitability, where they get an A+. Now, gross profit margin looking strong at 60.2%, with the sector at 57%. Bottom line though, no surprises, negative 4.7%. However, we do note the sector isn't too far off at negative 4.6%. And one thing that we always like to look at is the cash from operations. It is a lot for Pfizer at around 8 billion, with in fact sector median negative 15 million. So a quick recap for this part of the analysis: a double buy from Seeking Alpha and Wall Street, with a hold from Quant, A on valuation, F on growth, with an A+ on profitability. Now, how does Pfizer compare? Do we see any trends with the market against others in this sector? We have Sanofi, we have Novartis, as well as BMI and a few others that we have reviewed on this channel. And what in fact we can see over the last year, Pfizer is one of the worst performing, down 16%. Bear in mind, this includes reinvesting those dividends. But the interesting thing to note is that 2 other companies have also returned negative over the last year, BMI and Zoetis, as we can see. Now, expanding it over the last 5 years, we see Pfizer as the worst performing, up only 2%. And those that were negative over the last year, BMI and Zoetis, having a marginally higher growth. But overall, you can see over the last 5 years, not really the greatest growth in the industry, the best being NVS, which is up 58%. And when we take a look over the last 10 years, we can see Pfizer again up around 55%. In fact, across the board, very poor return. The only one that looks very strong is Zoetis, up 489%. In fact, one that we have reviewed not too long ago as definitely one to consider for the portfolio. Now, just because Pfizer has been very poor over the last 10 years doesn't mean they will be poor over the next 5 to 10 or whatever your investment horizon is, as past performance ultimately doesn't determine the future performance. One of the main key things that we like to look at is how has it performed against the S&P, because even though it has a nice yield, if you are looking at the total return, you may as well invest in the S&P 500 with a low-cost ETF, but that is only if you don't think Pfizer can outperform. S&P, significant outperformance over the last year. Over the last 5 years, again, massive outperformance, and no surprises here when we look over the last 10 years, not coming close to S&P massively up 173 versus Pfizer's 55. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, how we got to the $35 intrinsic value, we ran it through 4 models. The first one being the Graham's valuation. We have the ticker symbol, the EPS, long-term growth rate, yield on AAA corporate bond, with the intrinsic value here giving us a higher amount than the market value. So we have our first undervaluation signal. Bear in mind, we're not looking at any of these models in isolation. We then have the multiples valuation, a couple of companies that we just analyzed, their average PE multiplied by the EPS of Pfizer to give us our second undervaluation signal, 2 for 2. And then we take a look at the dividend discount model. Average growth around 3.14%. We've gone a little bit lower at 3% as we can see here, showing us our third undervaluation signal, with the fourth one being the DCF model. Free cash flow year on year, average around 3.5%. Moving forwards though, we do anticipate around 6%, which is slightly lower than management targets. With our discount rate, we get the present value of future free cash flow and terminal value. Add together with the cash, subtract total debt, get to equity value, divide by the shares outstanding, and as we can see here, 32.52, our fourth and final undervaluation signal. Now bear in mind, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Pfizer or any other company. We then get to the margin of safety. We use 10% as our starting point, execute on this if it meets our 3 golden criteria. Wide moat, strong financial metrics, and good forward-looking data. Now, if you believe this, it is a buy up to around $31. Then we keep going till it's near the current trading price. You could argue it isn't too far off a 20% MOS up to around $28. Right now, though, it is sitting somewhere between the 15 to 20% level. Now, Wall Street also indicate this as a buy with 33.83 as their price target. Upside of 19%, definitely one to consider if you do like a nice yield and you do believe over the long term you will see a much better performance than what we have seen over the last 10 years. If you want a bit more detail behind what they are looking to do in the future, do check out our other Pfizer episodes where we talk about the acquisitions they've had as well as items they have in the pipeline. As always, if you've enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter by clicking on the pinned comment below, and also joining us on the Patreon as well if you do want to run through our weekly buys and sells. As always, have a great day and we'll see you all on the next one.